remain your loyal girl. Welcome back to my channel. I remain your loyal girl, Olayemi Akinola, your one and only financial professional. I've been in this financial industry for the past 2 years, and it has been an amazing journey for me. And that is why I'm going to share common financial mistakes that people make on daily basis. Being in this business, I've seen a lot of things when we're analyzing financial need analysis for people. And one of the common mistake that people make is that they spend more than they make. You don't know that. It's maybe, for instance, you make like $100 per month, and you are spending like $120 per month. You'll be like, oh, how is that possible? It is very possible, because we are living in a credit society. Before you know it, you're just swiping those cards, right? It's so fun when you swipe them, but it's money. And the interest rate on those credit card is not funny. 20%, 30%, 25%. What does that mean? If you are owing $100, you're going to be paying back with $125. That's the implication. So you want to avoid that as much as possible. Let's look at another mistake that people make. Not budgeting. Not budgeting. If you budget, that's going to be a solution to the first mistake that I highlighted, which is spending more than you make. Right? When you budget, stay within your budget. Be disciplined. Be focused. Don't let that credit card. I have $20,000 on my credit card, so I can spend 2,000, whereas your income is 1,000. Chinedu, come here. Let's talk. That's not how to build wealth. That's how to build poverty. That's how to transfer generational poverty, not generational wealth. You need to build wealth with good budgeting, with good spending habits. Your lifestyle, you have to look into it. Some people want the best of the best. Yes, it's always good, but can you afford it? If you cannot afford it, then don't try it. If you want to use money, you want to borrow money to afford it, my dear, you're joking. It's a matter of time. You'd be stranded, and you don't want to be stranded in this part of the world. So therefore, you need to be, you need to be systematic in your approach when it comes to your finances. Having no emergency fund is another mistake people make, and they want to rely on credit card as their emergency fund. No, don't confuse the two. Emergency fund is so simple. Having a savings account, putting some money for raining days, such as if you are laid off your job, if you need maybe money to do home maintenance and insurance doesn't cover such, you want to have money somewhere to be able to settle those things. Please do not make that mistake. You can automate your income. Let's say 20% coming from your paycheck to a particular savings account. You don't go there until you need that money, seriously or urgently. That's when you access it. If people say, come and do this for me, come and do that for me, if you don't have your money in your checking account, you don't go to savings account, because savings account is for rainy days, when things are critical and you need to do something about it. Waiting too long to start investing is another financial mistake that people make. You might think you have time. Time is the enemy that we all have, because it doesn't wait for anyone. It goes like that. And then if you are in your 20s, you might be thinking you have more time. Ask the people in their 50s. They will tell you they don't have time again. They too were thinking that way when they were in their 20s, that I still have time, I still have time to invest, I still have time to put in this. Now, if you're in your 20s and you are working, the amount you're going to put in to your retirement account or to your investment options plan is quite different from somebody in their 40s, somebody in their 50s. And so also, definitely your orientation will be different. In your 20s, you might be aggressive in terms of risk, right? You might want to go into crypto, go into stocks, real estate. But somebody in their 50s, in their 40s, they already know that they don't have that much time again into retirement. They have to be conservative. They have to build slowly over time to create that wealth. But if you're in your 20s, yes, you can just do trial and errors, right? But if you want to be systematic in your approach to build that wealth, you have to follow a systematic approach. Know the ones that are real, know the ones that are volatile, and know the ones that are just there just to grow passively. Like all these high yield savings account, they're going to grow passively. But if you want a decent increase, then you want to go into open market. Buying a new car is another financial mistake. Like 3 years ago when we were buying new cars and then they were giving us, we're so happy, right? Oh my God. Chino, yeah, come here. It's not true. That is not how life is. The life there means that you're going to be paying more into mortgage, more into interest rates, whereas the car is depreciating over time. The car is by the time, but after like 5 years, the car has already depreciated over 50% of its value, but you're still paying into the original value. So if you really need a decent car, just buy the one you can afford. If we know what we know now, then we wouldn't have committed that error. That is why we are preaching it, so that you don't commit that same error. And if you want to commit it, you will not say that you did not hear before. Now I've told you what that meant. Not having proper insurance is another financial mistake that people make. I've seen a lot of people, they needed, that help at that point in time, but because they don't have the proper coverage, they will deny their claims. They will tell them to pay higher premium and all that. So you want to be sure whatever you are getting is worth it. Ask questions. So that, because when you need it and you're not asking questions, nobody will attend to you, nobody will answer you. Not paying attention to your credit score is another financial mistake, because the lower your credit score, the higher the interest rate of any services you want to get. Either you want to buy a car, you want to get a house, you want to buy investment properties. If you have poor credit scores, it's going to affect all those things. And imagine, I've seen people, their interest rate on a particular thing is 3%, and they are offering the same 3%, the same services to another person with poor credit score as high as 12%, 13%, 14%. Why? Because credit scores. So you want to pay attention to all those things. It matters a lot in this part of the world. If you have a poor credit score, it will be difficult for you to get good services at a very decent interest rate. Pay attention to that. It goes a long way. Living without budget, I think I've said that before. Please, budget. Don't spend more than you are earning. And then failure to plan for retirement. I've seen a lot of people in their 50s, they even have less than 100,000 to retire on. How? Imagine this kind of people at age 70, they will still be at workplace because they fail to plan. So do not start now. The solution is to start now, regardless of your age. Start now. Of course, the more you put in will be dependent on your age and other factors, but start now. At all, that one is bad. Just start. So let's put a stop right there. And I believe that if you have additional things, financial mistake that people make, you can drop it into the comment section. Let people learn. I've learned mine and I'm sharing mine, so we can all rub minds together. Please do well to subscribe on our page and engage our community. Thank you. Until we meet some other time, I remain your loyal girl, Olayemi Akinola. Bye.